Welcome back. Pitti Engineering has signed they will be paying an amount of around 125 crore rupees for this acquisition. Akshay S Pitti, the Vice Chairman and Managing Director of the company, is joining us now. Thank you so much for joining us. First up, if you can tell us the rationale for current business, that is, and how will you be funding this acquisition?
Strategic in nature for us. We have one large lamination manufacturing facility in Aurangabad, capable of doing 72,000 tons per annum. The facility is based in Karnataka, especially Bangalore, which is a large consumption center. With the facility there, we'll be adding about 18,000 tons to our capacity, taking our cumulative capacity to 90,000 tons. This is firstly in line with our target to reach 150,000 ton company. Secondly, this company specializes in doing products for smaller motors and pumps. This will help us utilize the raw material more efficiently, as we are predominantly into the larger lamination and generator business. So there we get a lot of synergies in the material utilization. Material as a percentage of cost of sales is about 70%. So even a couple of percentage points of benefit there can completely change the profitability landscape of the combined entity.
Right. We want to understand a couple of more things from you. With onboarding of this new capacity, number one, how does the composition of the order book change? What are the existing orders in the acquired entity? Number two, going forward, how does the revenue, EBITDA and profitability landscape change? We also understand that there are some deferred tax that you will be able to take benefit from. Can you help us in terms of exact numbers?
The deferred tax number will become clear after the financial year end, so I cannot comment on that. But in terms of the product profile, the company has very different product profiles. They are, like I said, predominantly into pumps and smaller laminations. Therefore, the utilization would change. In the pump and small motor industry, they are currently doing about 16,000 tons of sales at a turnover of about 275 crores. And the EBITDA of that entity is about 16 crores. With the synergies that come from Pitti Engineering's raw material utilization, we estimate that the 16 crore EBITDA can be increased up to about 30 crores going forward in the next financial year itself, with better utilization of material and rationalization of logistical cost.
Okay, all right. So give us 2-3 numbers then, Akshay. How much will margins increase by, since you're talking about EBITDA increasing going forward with this particular acquisition? And second, you did not answer, how are you going to fund this? What would it do to the debt structure post the acquisition?
So on the funding side, as on 31st December, we are very comfortable with a net debt of about 315 crores. This acquisition is about 125 crores. So we are quite comfortable with the debt number post this acquisition. After that, that would be about 450 crores.
This will be in the combined entity?
Yes, it will be in the combined entity.
Okay, okay, all right. And do you have to pay any debt for that entity as well, which is separate from this 124 crores?
Yes, so as part of the 125 crores enterprise valuation, there's a 30 crore debt in that company, which we intend to repay to its existing lenders, and the remaining 95 crores of equity will be cashed out to its existing shareholders.
Okay. Also, we want to discuss about, the impending amalgamation with Pitti Castings, that you're doing it with yourself. What is the current status of that? We understand you've received the NCLT approval. So when does that come on stream, and how does it impact the financials in FY25?
So for Pitti Castings, again, that company is doing about 18 crores EBITDA per annum, and majority of its sales, about 70%, are to Pitti Engineering itself. So by adding a consolidated 50 crore top line, we would be adding about 18 crores of EBITDA to the company. So the margin profile of the merged entity along with the acquisition would be closer to about 17% EBITDA on sales. And the sales for next year is forecasted to be about 1,500 crores on a consolidated basis.
So FY25 sales will be around 1,700 crore rupees and EBITDA margins will be around 17%.
Yes.
So will this also include the new facility that is coming up in Aurangabad?
Yes, it will also be contributing from the Aurangabad facility.
Okay. And what will the capacity utilization be? By when do you expect this acquisition to integrate? What is the initial capacity utilization that will lead to such revenues and margins?
So the existing capacity utilization there is about 70%, and the integration should be done by May end. That is what we are estimating. And the capacity utilization at a consolidated entity basis should be about 75% for FY25.
Okay. Finally, just give us very briefly a sense of, how ordering activity is. We have, the election code of conduct that is coming in. Just give us a quick outlook on how ordering and demand trends are.
So in the long lead time segments such as power generation, data centers, railways, mining, oil and gas, we have very long-term order cycles, 1 year and above, and those are remaining strong. In fact, we are seeing very, very strong order inflows coming in those segments. The second segment, which considers of the home appliances, pumps, small motors, here the order cycles are typically short-term in nature. And despite the election code of conduct being impending, we are seeing good order flows coming in there as well.
Thank you so much for your time. We have to wrap this conversation. We are running over time. First up, that's all the time we have on this edition of Midcap Radar. Mutual Fund Corner when we return.